So this is our agenda. We have 5 agenda today. So the first one, we will talk about the trading plan. The second part, we'll talk about the money management. The third part, we'll talk about the process, the elements that are required to develop a systematic trading plan. So this is a difference to discretionary trading plans like people using technical analysis. So without back testings, you can't really know this work or not. These particular ideas is work or not. So to make it a systematic plan, we need to go into the process. So I'm telling you the process and how to do it. The fourth one is optimization. So optimization is not new. The people want to know the best parameters to use, the best parameters for using a moving average, a MACD for particular markets. So there are some weakness on this angle. There are some shortfall. I will cover that also. So I'm presenting you the optimization in a different angle. Okay, later you will see. I actually use optimization to explore the trading plan itself, the weakness and the strength. Okay, is it a edge or is it just a kind of a shock scenario from the data? The fifth one is about after we backtesting, we have all the data, we have the results, we want to evaluate and we want to enhance it if possible. Okay, so in the previous webinar, we talked about a trading plan. So a successful traders will need a written plan to be systematic, to be consistent, profitable from the market. So basically, a trading plans cover everyone's personal characteristics, everyone's trading's behavior, your capital, your financial strengths, etc. So everyone will definitely have a different trading. Show you one of the sample of process and the trading plan. Yeah, so definitely everyone will have their own. You will need to go through the process to have in-depth understanding on what you are using on that particular indicators, that particular ideas on trading. Yeah, and this process is crucial for you to go long-term, especially in futures trading. So usually a good trading plan, definitely there's about trading method, there's about money management, the strategies, things like that. So we will go on to cover one by one. Okay, so trading plan, as mentioned, the most important part is about how to enter the market and how to exit the market. So the exiting the market, there's cut loss and there's also take profit. Yeah, so all kind of mechanism we want to test during the backtesting stage. And of course, we will need to implement risk management, how many loss to trade, how much capital to be ready. And of course, this risk management also help us to understand these particular trading plans, the maximum drawdown periods, things like that we will cover soon. And whatever you're trading, technical is one part of the work, and the other part you will need to really understand the market itself and the fundamentals, the factors that are affecting this market. Yeah. So you can't really miss MPOB data. Yeah. If you can't read MPOB data, this is definitely a shortfall. You don't know if the inventory is still keeping low, then the palm oil price will be pricing higher. Yeah. It's like what happening now. And of course, when the inventory is low, then your front month is way higher than your forward month, then this market is in backwardation. Things like that is about the fundamental of the market. And by trading, not only focus on technicals, you must actually have a top-down approach of the macro of the market sentiments. So a trader usually are an all-rounder. Okay, so this is a process. So first we will have the methods, then we will initiate into a trading strategy. So this method can be quantitative, can be statistics, can be technical, it can be fundamental as well. So the fundamentals approach, you must be able to quantify things like that, like ROE, PE, what kind of things that you want to, how to buy and how to sell. Yeah, based on all these methods, then initiate trading strategies. So a trading plan without a risk management plan to fail. You will have a 99% of winning ratio of one of the trading plan, but that 1% can kill your portfolio if you're not managing the position sizing well, the risk management well. So after we have that, we will go into back testings and we will evaluate the performance. Then we will do a forward testing. A forward testing is in the first webinar. I kind of present to you using the crude oil market. And present on the MACD indicators. Yeah, that is kind of forward testing. It particularly means we are using the same trading plan. We test on different markets, different time frame, and we want to see the result and evaluate the performance. And incubation paper trade is like a real-time trading, but on this basis is try to explore and discover what kind of things that we doesn't cover in the trading plan. So after some time of paper trading, you're familiar with this trading idea, trading plan, you're comfortable with it, then you can go live trading. So whenever there's a method, there's a new idea, we need to go through the process again. You will start from the beginning and do the back testings and evaluate, things like that. So this process is boring, this process is dry, and it consumes you a lot of times. And maybe out of 20 times, there was in 1 time, 2 times, you have a very good idea to approach, a good approach to continue. But the other 18 times is actually help you to understand what kind of elements that you miss it, yeah, things like that. So there's no process is wasted, all process are all process are important because all this process will lead us to a better trading plan. It always like that. It's like a learning cycle. Okay, so we'll talk about money management first. So first point about money management is about maximum drawdown. So let's say if you have 50,000 capital and you lost 20,000, we call this a 40% drawdown. Okay, yeah. So if I put into a graphical manner, so this is like your account level. So this account definitely start from around 7,000, then it grow to 10,000, like having a 45% of return. Then on the peak itself, then start having some losses trade. Then at the bottom, maybe is around back to below when you started is like below 6,000. So there's a drawdown like 4,000 here. Then you start rising again. So this drawdown usually is very important. That doesn't matter you are doing systematic trading or you are doing discretionary trading. This drawdown is very crucial. Why? Because the larger the drawdown, the it will be very difficult to become break even again. So let me show you this. So for example, you lost 25% of your capital. So to go back to where you started, the same capital, you will need to have a return of 33%. If let's say you lost 50% of your capital, you will need to have 100% of profitable, then go back to where you started. If the more you lost, the difficult to do it, the more difficult to do it. So for example, like people lost 90% on trading, so you need to do 10 times, yeah, to go back to where you started. So for on trading or in investing, the main key of things to do is actually not to lose too much of money, because you can't really overcome it. It takes a lot of times to overcome it. Yeah. So people tends to focus on trading method, trading idea, profitable things, but actually the most important things in trading is actually the loss part. If you can take care of the loss part well, then you will be fine. You will be working very well in the trading. Okay, position sizing. So the other way to call position sizing is money management. So why I use position sizing here is because of Rentap, I very respect Rentap use position sizing. So I also use position sizing here. But definitely you can call it money management, or you can call it account management in trading. Yeah. So basically, position sizing is for you to leverage your capital, okay, to ride on the profitable trend. Yeah. So how to do it, things like that, is in a very, very systematic way. Then everyone definitely have different risk perspective, different risk profile. So everyone will definitely have a different way to do this. So in backtesting, we will not implement any position sizing. What I mean is we will only trade one lot every time. So if let's say I earn more money, I can trade 2 lots or 3 lots. I won't do that because I will want to know the trading plan in itself without position sizing. What are the scratch performance? Yeah. So when we evaluate performance, we don't put money management into it. Once we put money management into it, we may not see the true result. Okay, so the first position sizing methods I want to introduce to you is called percent margin. So this is very straightforward. So for example, you have a account capital starting with 30,000, then we will implement a sizing methods 30%. it means every time I will only use 9,000 ringgit for trading. Yeah, if let's say I have 100,000, I will every time in futures, I will only use 30,000 for future trading. It means every time when I have a sickness in the market, I won't utilize the margin up to 30% of my capital. Yeah. And why is this important? So let me show you two different methods. So for example, you have trader A trading trader B. So everyone start from 30,000, okay, 30,000. So let's say there's a very solid news. What kind of solid news now? Maybe oil and gas sector is very good. This particular stock so good. Okay, so trader A hump dump 30,000 into the market on Monday to buy the shares. Let's say on 10 cent. Okay, so trader B come to this workshop. So he know percent margin 30%. So he hump dump 9,000. Okay, on 10 cent as well. Okay, then later I don't know why OPEC want to increase productions. So the share price drop. Okay, so let's say the share price drop 20% to 8 cent. Okay, so this also drop 8 cent. Okay, and this at 8 cent. Okay, when the price already dropped 20%, trader A definitely can't do anything because he have utilized all his capital. But trader B can buy another 30% if he wants. Okay, so he can actually buy another 9K at 8 cent. So the first sizings on 10 cent, the second sizing on 8 cent. Yeah. Then let's say the price rise to 12 cent. Okay. Trader A earns 20%, but actually trader B earn more. Yeah. But of course, trader B doesn't utilize all his capital. Yeah. In this scenario, trader B definitely earn more because of the slicing the capital. Yeah. So he have a cost of around 9 cents. So definitely he will earn more than 20%. So the outcome is way different. It's a lot different. When in stock investment, I also will do this. In future trading, I will definitely do this, but not at 30%. Yeah, I will try to do as low as possible. So my sizing in stocks is around 3 to 5%. My trading in futures is maybe 5-10%. Yeah, something like that. So try to minimize it as much as possible. It's kind of a way to diversify the systematic risk. Okay, so this is an example of the current margin. So the FKI at 4,002, FCPO 4,005. Soy oil may be a slightly different now. Okay, then in this scenario, this 30,000 capitals, we can trade 2 lot FKI because the margin is around 8,004. So we can utilize 9,000 ringgit. So no problem. FCPO now is 5,000. So we can actually only trade 1 lot here. Okay, sorry for the margin itself. Okay. Yeah, so this is a scenario on, so for example, on 6th February, you trade 2 lots of FKLI. You have an open position of 2 lots with a margin of 8,004. So you have utilized 9,000 ringgit. So you have 6,000 ringgit to utilize again. So definitely 600 ringgit, you can't really trade or have any open position. Maybe only spread trading. Then let's say at the same day, when you're holding 2 lots of FKLI, and you have a buy signal in FCPO, can you take the position? So the answer is no, because you have 2 lots with a margin utilization of 8,004, and if you want to buy another FCPO with 5,000 ringgit, that will bring your utilization to 13,400. But you only have 30,000 capitals, you can only utilize 9,000, so you can't do that. Yeah. So let's say the 2 lots FKI, you make 3,000 profit. Then the next day, you were starting with 33,000. So this time you have a buy signal with FCPO, of course, yes, because now you can utilize 9,900 ringgit. Yeah, etc. So let's say on crude oil, the current margin is 5,000 US dollar. You can't really do that. Yeah. So you may not feel it until you do some paper simulation on this scenario. You can do multiple simulation on 30% margin. Why? Because when trading and when you are very bullish, especially when you earn money, you become psychologically excited. So when you don't follow rules, yeah, usually the disaster will come. We see this so many times. Yeah, that's why it's crucial that you have a fixed position rules. Yeah, of course, position might sizing methods can be many, but this is one of the one that very suit retail investors, especially like us. Okay, the other method is called risk per trade. So I'm showing you a table. Okay, we have two types of traders here, trader 1 and trader 2. So each of them did 19 trades. So here we are doing a worst case scenario analysis. So that 19 trades are all making losses. Yeah, all loss. So both of them start with 20,000. So the first trader, you will risk 2% every trade. So 2% of 20,000 will be 400. So you will lose 400 in the first trade. Then the second one will be 19,600 of 2%. It will be 392 ringgit, etc. So after 19 trades, this trader one will have a drawdown close to 30%. Okay, so it's at 13,000. Yeah, 25%. Yeah, to precise, 25% of drawdown. Okay, so you look at trader 2. So trader 2 risk 10% per trade. So the first trade he will lose 2,000. The second trade will have a starting capital of 18,000, lost 1,008. Then after 19 trades of continual losses, he will have around 3,000, 2,007. Yeah, so the drawdown here is huge. So it's around 85% of drawdown. So imagine which traders will suffer most in the trading journey. Yeah, of course, it's trader 2, because have a drawdown like that. Yeah, and this 2% risk per trade is not something new. It's written in Turtle Trading, that book, Michael Covell, or even the other author also write about this 2% risk per trade. So when I just came into this industry, and I just learned about this, it feel like ridiculous. How can I tell my clients to only risk 2% per trade? Something not right there. So I never respected until I start doing back testing, then I know all these things are so important. Yeah. So the second rule today is risk per trade. Of course, 2% could be the maximum. The lower it can go, the better. That means either you improve your capital or your every slicings of risk is reduced to maybe 1% or 0.5%. If you can do that, then your portfolio will definitely be very sustainable. Okay, so let's say again, 30,000 of trading capital with risk per trade 2% of these rules. Then every open positions you can only lose 600 ringgit. Yeah, it's like so little, right? But actually, it's achievable. It's really achievable. So in this trading plan, I have compute all these money management tools that you can see from what angle and how to plan on what kind of time frame you can trade using some kind of indicators, and it will not conflict to your money management. It's all aligned, all harmonized. We need to definitely follow all the rules. Okay, so these is the indicators that I'm going to tell you. Okay, so it's not new, it's average true range, it's ATR, and that parameters also 14 is by default. Okay, so here I'm showing you three markets. We have FCPO, FKI, and oil here. Okay, and the differences is about the time frame. The FCPO is 50 minutes, the FKI is 60 minutes, and the oil is 30 minutes. By the way, ladies and gentlemen, you have any question, please post in the Q&A box. I'll come to you. Okay, don't be shy, don't worry to ask me anything. Okay, it's a beautiful Saturday. Okay, here the risk per trade is following the ATL itself, following the ATL reading. So for people that don't know or just new to ATL means the true range of every single bar relative to the next bar. So if let's say you have a gap up, you have a big movement, definitely these indicators will rise. Okay, so let's be simplified again. So look at this ATL FCPO 15 minutes. So that reading is 18. It means in every 50 minutes in the FCPO market, every 15 minutes candle, the potential high-low range will be 18 point. Not necessarily high-low range, is actually the closing, is this bar closing compared to the previous bar high or low. depends on the maximum of the range. Yeah. So of course, when trading, we want this to be higher as possible, because let's say we enter the market, we want the market able to move either way. We don't want the market to sleep. So when you have a rising or high average true range, it's good for trading. Okay, so let's look at FKI. So FKI, since January, the average true range is dropping from 10 point to 5 point. Okay, so this declining volatility in the market is bad for trading. So when it's bad for trading, so you have two ways to do that. Either you increase the time frame to have a higher true range, better manage, okay, and hold it for some time, or you just ignore the market until the volatility come. Of course, it depends on your trading strategy. Is good for is trend trading plan or is a sideways trading plan. It depends. Yeah. Okay. So what I'm saying here is to apply on trend trading plan. It means it's a trend following trading plan approach. It's a breakout trading plan approach. So oil is rising. Yeah, you know, oil price is near to 60. Oil inventory is still very low. Then this is good for trading when the ATR is rising. Okay. Okay, so here, why I pick FCPO 15 minutes is because the risk per trade is around 20 points. So it's around 500 ringgit. FKI 60 minutes, the current ATR is 5. The highest ATR is 10. So it's around 250 to 500 ringgit. So with a 30%, with a 30,000 capital, 2% risk per trade, we're still able to trade this two market with one lot risk per trade. It's still manageable with 2%. Of course, oil, you need more capital, or you use the E-mini crude oil to manage that. 1 minute chart in FCPO 2% loss definitely is manageable, but it depends on how you do it and how much capital you start with it. Are you doing intraday margin? Of course, there's so much variables to there's so much things to be clear before I can answer you this. Of course, the lower the time frame, the lower the volatility. It means it's more sensitive to the market sentiment. So 2% on 30,000, your risk per trade is 500, 600 ringgit. Definitely 1 minute chart is in FCPO is manageable. Okay, so with risk per trade, these rules we can also do the other manner. We can actually determine how much capital we need. Okay, so for example, if let's say you want to trade FKI, okay, 60 minutes FCPO, 50 minutes